The borrower, and likely the banker in this scenario, is going to go, oh, we're good, we're golden. The borrower has $50,000 worth of flood insurance in place. The damage is $30,000. We've got $20,000 worth of grace. We're golden, we're good, right? Not in the insurance industry's eyes. Because the structure was not insured to 80% of the insurable value, the borrower doesn't have full coverage. They're going to have percentage-based coverage in the event of a loss. Here's how that works. They're actually only going to get, in this $30,000 loss, they're going to get $18,750 less their deductible. You might say, well, how in the world does a $50,000 policy only pay out $18,750 in a $30,000 loss scenario? That's where the 62.5% comes in. The insurance industry is going to take the loss, $30,000, and they're going to take it times 62.5%. And I'm going to go back a slide here and put that back up so you can see it. They're going to take that $30,000 loss times 62.5%. What you're going to get when you do that is $18,750. Okay, and then you'll also back the deductible out of there. So if they have, let's just say they have a $2,000 deductible, then they're only going to get $16,750 in the event of this loss. Now, from a flood insurance compliance standpoint, you're good. You had a $50,000 loan, you required $50,000 worth of coverage. You met the compliance requirements. This is where safety and soundness in the insurance industry need to make sure that they align with one another. Because safety and soundness usually doesn't understand that, oh, wait a minute, if we have a loss, we're only going to get 62.5% of that loss. So even if there's a full $50,000 loss, not going to get $50,000 in coverage. You're going to get 50,000 times 62.5%. Okay. The only way you get full $50,000 worth of coverage is if you'd had, in a $50,000 loss scenario, is if you had $80,000 worth of coverage in place. The insurance industry is weird, folks. I get it. Okay. You don't always get what it appears that you have in your policy. You have to read the fine print. Most people don't. There's a lot of agents that don't understand it this way. Okay. This is the way the insurance industry works. You don't always have what you think you have. Now, from a compliance standpoint, we're good, but there's safety and soundness risks here that you need to be aware of. Does your borrower have the ability to come up with the difference between $30,000 and $18,750? Hey, if they don't, you have a problem from a safety and soundness standpoint. You might have a property that you get gifted the keys to because they walk away and go, we're not fixing this. And that's happened in several of the hurricane scenarios in the past. And so we want to make sure that you're aware, armed with knowledge.